What's up, guys? Welcome to week 25 of my trading reflections. Without further ado, let's get right into this trading week. So basically, looking at the economic calendar in the beginning of the week, we already knew what the best times to trade are. By the way, if you don't know about this, it's literally just pulling Forex Factory on your trading view chart, which is amazing. You don't have to go to the website anymore, so just type in news indicator from 2 degrees and filter this on high impact news and on USD currency, and then you'll have this. And now looking at this, obviously we knew that Wednesday and Thursday were the best times to trade because the most amount of volatility got injected here, and so most interesting to trade, right, if you know what you're doing. So nonetheless, I took a look on the price action of Tuesday because I thought it was really interesting, and I tried to form a nice trade idea based on that price action. So let's talk about that right now. So this was Tuesday's price action. I think it looked really clean. This is a setup you could have taken. Basically what happens here is there's an hour one fair value gap right here, which is obviously in premium. I don't use discount fair value gaps if we are shorting. But what made this interesting? So I'm constantly looking for cracks in correlation, right? So cracking correlation, the most known one is an SMT, of course. It's something that happens on one pair, not on the other one. But if you take this to the next level, you have SSMTs, right? Which I marked down right here. All credits to Day for this. It's basically sequential SMT, and it happens between different quarters. So taking that time aspect with it, it just becomes way more probable. So basically what happens here is we have a 90-minute sequential SMT between the previous 90 minutes of the session and the current 90 minutes of the session. So I think ES or the Dow did not trade above these highs. So that's a cracking correlation. Maybe an universal can occur. This happens within an hour on fair value gap. So it becomes interesting, right? Not really a nice setup yet, but if we take a look at ES and compare it with the Dow, you can see that, let me delete this news indicator. You can see that right when this 90-minute SMT formed within this premium fair value gap, that at the right time, at the New York Stock Exchange open, which is 9:30, you can see right here, there was a precision swing point forming. And so what a precision swing point is that it's a different candle on one pair, like an up close on ES and a down close on NQ, for example. And so this is also a form of a cracking correlation like SMT, right? So we can use this to add even more confluence to that there is a reversal maybe gonna occur right here. So looking at this, you can see already, look at my cross. This is on, at the exact same time, the minute 5 candle on ES is a down close candle, see this? And then on NQ it is an up close candle. So together with this confluences, it may indicate, okay, this is a nice trade, right? So going onto the minute 1 chart on NQ, okay, we have this precision swing point right here. Let me mark this out. And we have a nice setup, right? Most importantly, because we have a clear draw on liquidity, right? This is always what I want to see. I always want to see these stacked lows like this, like here. I think these lows are really clean. This is clean, low resistance liquidity that we can target. And as you can see, once we go break to the first low, we immediately just run all of this. That's why it's called low resistance liquidity, right? So I think this was a really clean setup. You saw the hour one fair value gap tap. You saw that a 90-minute SMT. There was also a precision swing point right here at the right time. New York Stock Exchange open, right? Kill zone. We have clean draw on liquidity. We have a change in the state of delivery. We basically just disrespect this fair value gap. And that's when I just think it's best to just trade the first fair value gap and then target the lows, right? So I think this looks clean. And even on top of this, right, not only a fair value gap is a type of gap, we also can use new week opening gaps and new day opening gaps, right? So if you take a look at the new day opening gap indicator, these are my settings. I also copied these from Day, so full credits to him. It's an amazing indicator to check for new day opening gaps because they act super well for trades. Because if you hover this on, you see that this here, this high, this precision swing point high was basically literally just tapping a new day opening gap. So now we have a great setup, right? We have price at New York Stock Exchange open, tapping a new day opening gap, forming a 90-minute SMT, inside premium of this range, inside an hour 1 fair value gap. We have clean low resistance liquidity to target, and then we have a change in the state of delivery because we just disrespect this fair value gap. We have clear bearish order flow right now. We just enter on the first fair value gap, stop at the high, and then just take everything off right here because we did have a bullish order flow on the higher time frame. So I just want to target the low, right? So after that, I think we have had weekly SMT right here, and some SMTs right here, I think, yeah. And we were also inside a macro. So looking at this, so the macro is from 9:45 to 10:15, right? I think this is from Zusi, because usually I thought that the macros are always 10 minutes before and 10 minutes after, which is correct. But I think with the World's Words of Wisdom podcast, he mentioned that actually the macro, he's seen it working better if he took the 30-minute window. So from 9:45 to 10:15, from 10:45 to 11:15. So that's what I'm using right now, and it really, really works great because as you can see, where do the most important things happen here? It's inside this macro, right? Because when this macro begins at 9:45, we have price running through these lows, S&T right here, and then again reversing and taking out this high. So everything basically, like if you took a trade on Tuesday, it most likely happened during this macro window because this is where the clean setups form itself. So yeah, I think really, really interesting price action on Tuesday. So that's why I wanted to touch upon this really quick. But let's go to Wednesday. And Wednesday was an interesting day because if you take a look on the indicator. So look at this. On Wednesday, we had FOMC and CPI at the same day, right? So 8:30 we had CPI in the morning session, and then we had FOMC at 2 p.m. in the afternoon session. So that's really, really interesting. A lot of people got some great setups. I misread the charts, and that's why I want to talk about this right now, so we can learn from everything we have done wrong and see where the good setups may have formed. So mark on first the Wednesday AM session, which is CPI, I think. So on CPI, there was not really a setup if you didn't enter already way before. Just because, like, if you're longing right here, you're like, what are you gonna target? Like, I really want like some clean internal draw and not just target some, I don't know, we are at all-time high, so I didn't know what to target. So but it's interesting nonetheless, just because if you take a look on this, just before this CPI candle, CPI, right? Yeah, CPI. Just before this, we basically had a 90-minute SMT and a micro SMT. So it's really interesting because it's also below the true day open, so at midnight, and the true session open, which is 7:30 a.m. So I don't know if you noticed, but usually CPI almost never just wicks price to manipulate and then go to the other side. It usually just expands in one direction without stopping out the other direction. Like if you go to the chart, you will see it over and over again. And so if you have cracks in correlation, signs of reversal, for example, here we had 90-minute bullish and micro bullish SSMT, then you can predict the direction of CPI, right? Especially if you connect this with all other confluences. You should not just focus on this alone. You just focus on the higher time frame order flow, on the true opens, where are we in terms of structure. But this is really, really interesting because I just see it working every time over and over again before CPI. Just look at what happens, and usually those small SSMTs on the micro or 90-minute, which are actually very low time frame, just before CPI, these will hold more importance because this is just before a news event. So if we, for example, have like daily SMT right here, yeah, maybe it can work if we at CPI have another lower time frame SMT at the highs. But just because just before CPI we had this micro SMT and this 90-minute SMT, it makes it just way more strong because it has that time aspect with it, right? That's what I realized. And also at the time, I think ES retraced to discount, etc. So this was actually a good setup if you just are a trader who is just targeting a set RR. But for me, I want to target the clean highs, and for this setup, that was not present. But if you then go to the PM session, on Wednesday was actually really interesting price action. I took 2 L's right here, and I want to talk about this because it's really interesting to learn from this. So let's go to the 1 minute time frame. So going into FOMC, this is different than CPI. CPI usually just expands in one direction, right? Just as we've seen right here, just one direction, just a crazy pump or a crazy dump. Now, then at FOMC, usually FOMC and those other high impact news events like NFP, they usually manipulate and then, oh my God, manipulate and then they expand. So that's exactly also what happened right here. We first manipulate and then we go to the draw on liquidity. So I think the news was right here. See here. So at FOMC, you always have like 2 red folders. It's one at 2 p.m. and one at 2:30. So usually the first one, it just manipulates price. And then the second one, it just tries to like expand towards draw, right? So that's what happened right here. FOMC opened, we just completely dumped, right? And so a lot of people, they shorted this, but you should see this as the manipulation before then going to the draw on liquidity. So that is actually what happened right here. And I took some L's just because I was focusing on, okay, this was a manipulation. We're going to the highs. And then now I saw some SMTs right here, SMT, 90-minute micro, and then here, maybe another one. And I thought, okay, we manipulated, we then took out the highs, we have SMT, now we go down. But I failed to see the bigger picture. Because if you look at this, this is just an entire market maker buy model, right? This is the buy model of FOMC, which got completed during FOMC. Why? Because we just continuously stacked up buy side liquidity on the highs, obviously, right? So this was the clean target of FOMC. We had these nice stacked highs, and this was the entire idea of FOMC. We first just manipulate inside some kind of gap, and then we try to finish the buy model, which is what happened. But because I saw these small SMTs right here, I just saw displacement and I just shorted right here, and I got stop tied twice because I didn't saw that this was a clean market maker buy model, and basically I was just constantly the liquidity for the market makers, right? However you want to call it. So the better read on this price action was to look at this market maker buy model. This was the final target, and then basically what happened, FOMC dumped us. This is the manipulation. We just go up. Okay, I thought the market maker buy model was completed, but it was not, because this was the final target. So this should have just been a retracement back to discount of the range to then maybe do a little stop rate, which happened right here, to then go towards the draw. So the setup, in my opinion, that really made sense is basically this was a draw on liquidity because we have all these stacked highs right here. We then first at 2 p.m. FOMC red folder news, we have price manipulating towards discount, fill some gaps, and then we have price expanding to the draw on liquidity. So obviously this was maybe too much consolidation, so maybe not the best price action, but it all makes sense, right? We just go back to very deep premium to then have a stop rate right here, and then we form a clean 1 minute fair value gap where you maybe could have entered right here. If you want to be reckless, just put your stop at the fair value gap low. But this was actually really clean, right? So you can see that the whole purpose of FOMC was to take out the highs. And then after this got taken out, it doesn't really matter what happens after it, because the move, the draw on liquidity was already met. And then we took out the data lows, which was actually my target for the shorts I took. Now the thing that was supporting this was a daily SMT right here. And so basically after we took the draw on liquidity on FOMC, then we formed another daily SMT right here. So that basically deleted this one. And then we took out the data lows, which was my initial target for the shorts, but it could have only had taken out if we had taken out this buy model first, and then we have an opposing SMT, and now we go here. And I don't really care what happens after this because it's just the last 30 minutes of the market, not really high probable. So this was a price action you should focus on, which was actually really clean in my opinion. So that was FOMC. So lastly, let's talk about Thursday, which is, in my opinion, also an interesting day, where I actually took my win of the week. A really nice trade I took. So let's talk about Thursday's price action. So if you take a look on the news indicator, this was the CPI candle at 8:30 on Thursday. And basically what it did is it just manipulated lower into discount to then finally expand and finish this buy model, take out this external high, and basically this model is now completed, right? But how could we have known, like if you just backtest this, how could we have known that this was going to happen? Well, first of all, maybe it looks like a clean market maker buy model, right? Clean stacked up highs. But also we had a daily SMT right here and another lower time frame SMT right here. So this crack in correlation was already established. So unemployment claims already takes this information and knows, okay, this is the trial liquidity. This is how I look at it, right? So then we took out the highs. Now what's next, right? The market moves from liquidity to liquidity. So now we have some clean stacked up lows. So I'm targeting the lows now for a market maker sell model. And this was my trade basically. So after we took out the buy side, we displaced really strongly down, indicating that the order flow is switched. We're going to target the lows now. Then we retraced back to equilibrium of this range, filled some gaps. Now we are at 930. 930 is somewhere right here. And then we had a displacement down, disrespecting this fair value gap. And then I just shorted right here, stop at the highs and target the lows. Let me see what else I have drawn on this chart. So yeah, as you can see, this was my first TP. This was my second TP, just because I thought, okay, we're just going to rebalance on the higher time frame to this 50-minute fair value gap, as you can see right here. So it was my TP2. And then what else do we have here? All right, so I said this was a daily SMT. And this was a colliding SMT. What is this? It's something that really works well. It's basically a 90-minute SMT that also is a micro SMT at the same time, because it's literally such a small SMT between, like here you can see 5:53 and 6:20, which is between sessions, but also between the 2 quarters of the 90-minute cycle, but also between the 2 quarters of the microcycle. So this is really strong. And so these cracking correlation, this daily with this colliding SMT, it basically started this smart money reversal, and then unemployment claims, it just completed this buy model. Then after this got completed, we had the daily SMT and the weekly SMT, and then we went down, and then we retraced back to premium around the New York Stock Exchange open. We were above the true opens, right? True day open, true session open. These, why do I neglect these? Yes, we have micro and 90-minute and daily SMT at the lows now, right here. But I neglect this just because we had the weekly and another higher time frame right here, right? We had a weekly and a daily right here. So we don't care about the daily because the weekly is stronger, and most importantly, the drawn liquidity to the lows is stronger, and we are above true day open and true session open right here, right? So if you connect everything, you can form some really nice setups. And that was my trade on Thursday. So that's basically it. Now going into my journal, this was my week. I basically took the 2 trades, the loss on FOMC on Wednesday, and then I took 1 win I just showed you on Thursday. And looking at this, I think my main takeaways from this week is that I should just really work on my risk management, because usually whenever I have a loss, it's a big loss, and whenever I have a win, it's a small win. And it's literally just also psychology, because in my mind, okay, I lost 2 trades on Wednesday, so I don't want to like end the week in like a big red, so I risk less on Thursday, but then it was a win and it was a smaller win. So you can see that this is not a good way of handling risk. I should for now just focus on putting the same amount of risk on every trade, because I think that makes more sense in my journey right now. I think, of course, a lot of traders, they adjust their risk based on the probability of their setup, but that doesn't really work with me right now, so I just keep with the same risk. I think that's important. So at the end of the week, I can have a clear overview of my performance. Actually, I think I'm just yapping. I think it's just important to focus on the risk to reward and just change this $ into an RR, because that makes much more sense. I should not focus on the money looking at my calendar, but I should stick with the same risk, of course. That's my main takeaway. So my frameworks I added, my playbooks I added for this week are 2 setups. First one was FOMC. So this was the market maker buy model on FOMC. Basically at 2 p.m. we manipulated down, and then we took out the trial liquidity of this market maker buy model, which is this external high. And yeah, I think a lot of people, they got stopped out shorting this, but this was a clean stop rate, and then we have displacement for vertical gap entry, target the highs. And this was also inside the macro, so really interesting, and it was supported by this higher time frame S&T, right? Otherwise I would not have taken this if there was like a bearish daily S&T. This is the most important thing as well. And then lastly, on Thursday, unemployment claims, what I just showed you, right? Really clean. We first at the news event had price displacing up because we had this daily and gliding S&T at the bottom, and then once this buy model is taken out, now we go for sell side. We're going to the lows because now we have daily S&T, also weekly S&T. So this is the strongest one. We displace down, retrace back to discount at 9:30, above the true day open, true session open, clean around liquidity. And yeah, that's basically it, man. So yeah, we just keep going. Next week, another week full of opportunities. Some people ask me to share my chart colors, so I'll just quickly, I think you can do it right here, sharing. Copy link. I'll put this in the description of the video. So on to the next week. I hope you had a nice trading week as well, and that just means that you learned from your mistakes. It doesn't mean that you made money. So let's keep it going, and I'll see you guys in the next one. Peace out.